We have with us market expert Sunil Subramaniam joining us to discuss about what lies ahead as well. Sunil sir, good afternoon. So good to have you back on a day like this when the government, the OMC companies have hiked fuel prices, but the stocks remain depressed. Of course, the talk of the street is that these price hikes are not enough for now. So do you believe that this is merely the beginning of a larger fuel price hike cycle? And can the government realistically pass these steep increases to consumers?
So I think that first of all, the impact I think has been kept low because of the public. I think the government is very keen to keep the lower middle class and middle class happy. So from that point of view, I think to some extent in the March effect, you saw whatever stocks they had in February, it probably got used up. So the average cost for the government has not still gone up fully, but as the war prolongs, this effect will be much, much larger. And as you're aware that it's about 1,000 crores a day, which the OMCs were picking up as a cost. So that's about 30,000 crores a month. On top of it, the government had already reduced excess duties by 10% in both petrol and diesel. And that's another 14,000 crore rupees loss per month. So we are looking at a 44,000 rupee hole for the country as a whole, because these OMCs are all owned by the government of India ultimately. So I think that this is a token increase. And what the Prime Minister did was first he did ask for a voluntary compliance in terms of reducing fuel costs, work from home, use public transport, to avoid foreign travel. And all of that was a way of getting people sensitized to what is happening at the geopolitical crisis and that India is getting affected. The next step is to make a small token hike. But as the numbers clearly show, if an average oil basket of $65 to $70 is now gone to $105 to $110, you're talking about a $40 increase. And three is a number of cents that 3 rupees increases. So I think the purpose is not to fully recover it. The government knows that it's not possible for us in a democratic country for us to pass on the full burden. Because remember, when the we got cheap oil from Russia during the Russia-Ukraine crisis in 2022, we got solid discounts, but we didn't pass on petrol price cuts. So I think there has got to be a balanced perspective when the super money is made. Also, they didn't pass on the entire cost. It's not fair to expect the government to pass it on fully to the consumer at this stage. Certain amount, we are a welfare economy, and somewhere the intermediary players, which is both the government through its fiscal deficit and the OMCs through their profit margins, have to take a bit of it. Why the markets got disappointed today was because a larger increase was anticipated about 5 to 7 rupees, but only came in 3, which means now a greater share of the burden has been passed on to the OMCs, saying you manage it for time being. Your question on whether this indicates further hike, well, it all depends on how long the war lasts. I think for another 6 to 8 weeks, if oil remains at this level, the government could get away, would probably do just one more rate hike of a similar, maybe a month from now, and manage it. But if the war is going to stretch, or if it escalates and the oil goes to $125, then a further series of rate hikes is probably inevitable. But remember that though we decontrolled petrol and diesel way back, ultimately the OMCs are also perceived as an arm of the government. So one option with the government, which could be exercised, which was done during COVID, is to allow the fiscal deficit to slip. Because after all, it's a temporary one-time effect. And for this year's fiscal deficit, if it's allowed to slip to, let's say, 4.5 or 4.6 instead of the committed 4.4, I'm not sure that India is going to go for a rating downgrade. Rating agencies will understand these special situations and they will be tolerant. So I think I see no harm in India allowing its fiscal deficit to slip, just like it did in COVID time, to make sure that the burden is not passed on to the consumer. Now, the fiscal deficit slippage versus the OMCs, that's the challenge for the market. That if the government takes it on itself, it's a different issue. The second is that this oil price, right? It's only the retail consumer petrol, diesel that you're controlling. What about the industrial usage? That's anyway going to get the international oil prices. So the cascading inflation impact of the oil price rise is already going to be felt by the Indian consumer. On top of it, you don't want to burden him with a petrol price direct impact on what his two-wheeler or car travel is. So I would say the government will be very cautious with future hikes. It'll be of the similar nature of 3 to 5 rupees. But like I said, the next one will probably be reevaluated after a month. And then if the war looks like it's continuing, and then they may look at another one. So, but there's no way that the full $40 increase in the Brent crude is going to be passed on in a democratic country to the consumer at large.
Got it, got it. So at these current levels of crude prices at about 105 to 109, OMCs are still reportedly losing about 14 rupees per litre. So how
Correct.
serious is the earning risk for BPCL, HPCL and all of these OMC companies going ahead?
I think it's very serious, but remember that when they made super profits, they gave high dividends to the government. So I would expect sometime in the future, in this period, the government to think about taking the burden off the OMCs by issuing, let's say, oil bonds and giving them some pricing comfort. So at the back end, without the customer picking up the tab, the government can pick up the tab and put it in the form of a postponement by issuing oil bonds and bail them out from the current situation. But I don't think the least of the thought process of the government is to protect the OMCs from a stock market perspective in terms of the share price. I think that's the last concern. If the stock prices crash, government is not going to worry about it. For them, a larger issue is there. But yes, given the optics that these are large companies in India and a lot of foreign investors have also invested in them, they could look at relieving them of the burden through fiscal support from the government to these companies directly, thereby their P&L impact could be mitigated to some extent.
Got it, got it. Sunil sir, do you think the street has fully priced in the extent of the earnings pain ahead for all of these OMC counters, because they are going to report some bit of a losses in the first quarter? But going through the kind of estimation that we're having in terms of the elevated crude price levels, do you think that street has captured all of that?
No, I don't think the street has captured all of it because the street is expecting two things. First is that it was expecting that after the election gets over, this burden will get passed on to the customer higher than what it has today. So that the street has expected. Second is the street is also expecting the war will come to a close. Now you see, one Iran fighting against two major military powers like Israel and America, right? You can't draw a parallel to the Ukraine-Russia war because Ukraine was supported by whole of Europe and America initially in their fight against Russia. So Ukraine was able to hold out. Nobody expected Iran, without any support from any other country other than Yemen or Lebanon, to stand up for so long, right? And that's been something that's taken everybody by surprise, including the street. So I think that the street was also saying that even if quarter one earnings comes down, if the war is ending, it's then already sunk cost. The profits are lower. They would look to the future, saying, is in the next quarter, is the war effect continuing or not? So to that extent, the street would always try to look into the future and take a grace there. But I don't think that the street fully has anticipated that only 3 rupees would be the price increase and that the OMCs would be left in the lurch effectively at this point in time. So yes, so it is a bit of a negative surprise from a street perspective. But like I said, over the next few weeks, the government has a lot more decisions to take on bailing out the OMCs through issue of bonds and the like fiscal support. So I think that the street will still wait to see what the government is going to do specific to the OMCs. From that point of view, they could give them also a nice fund line of credit because their working capital costs also go up, right? Because they import the oil. So the government could consider a very low cost line of credit for them for financing their imports. And there are multiple actions the government can take to support these. So street will still be hopeful that the companies would get some form of support to ease the pain. But if that doesn't happen, the street has definitely underestimated the pain in the OMCs and could be in for a nasty surprise when the Q1 earnings get published in the middle of July.
Okay, got it, got it. So Lisa, rupee has breached 96 against the US dollar for the very first time. Crude prices remain at elevated levels of about $100. I mean, do you think that this is just a start of, what's going to be a broader depreciation? And do you think, what does this mean of today's rupee fall going ahead?
I think today's rupee fall has got to do with two things. One is that the government passing on only 3 rupees has also had its impact in the sense of the fact that your imported oil costs would anyway come through inflation, and India's fiscal deficit slippage is looking more and more likely. So, from a fundamentals perspective itself, the rupee, I think, has not been fairly valued at the earlier levels that was there. Also, the government, the RBI had done a lot of administrative intervention to keep the rupee from depreciating strongly. Now, those have kind of that card has been played. There's no more tools in the hand of RBI. The third is our forex reserves have already come down to around 675, $680 billion levels. We still have 11 months cover of imports, but the market is questioning whether how much more can the RBI afford to do this. So that's again a read. And if they have to do a swap like Mr. Raghuram Rajan did, right, which means that automatically rupee has to depreciate because there's a cost to pay for getting a swap done. So that's one factor. But also what's happening in the US. I saw that the US 10-year has now shot up past 4.55. And the
Hmm.
dollar index is again strengthened to 99 when I last saw it. So there is that pressure from the dollar strengthening on the rupee to weaken, right? Which is probably for all emerging market countries, including us. So multiple these factors. And to see the way forward, right, I look at the swap market. And I last saw the swap market, it was showing 385 points for a 1 year swap. So when you add 385 to current levels, you're almost hitting 100 for the rupee as a 1 year forward rate. So the currency market is telling you that if you want to go and uh, hedge your currency, that is, if FII is investing in India and he was says, I have a 1 year outlook. So 1 year, I want to be very certain how much money I can take out from India. And he buys a 1 year forward contract, he's going to pay equivalent of almost 100 rupees to a dollar for 1 year. So the currency market is telling you that there is a heavy expected depreciation. Of course, the end of the war and easing in Brent crude, US inflation coming down, the new Fed chair coming and saying, I'm willing to look at rate cuts. All of these are factors which would help strengthen the weakening stature of the rupee. So these are things that you have to continuously track and keep watch for.
Okay, got it. We saw the retail inflation for April coming at about 3.48%. Now, after the fuel price hike, how much of a pass through to the headline inflation do you expect over the next 2 to 3 months?
I think that about 25 to 30 basis points is what I expect because of the weight in the basket. So I
Hmm.
think about 25 to 30 basis point pass through, which means you should definitely breach 4 in the next print.
Okay, got it. So, do you think this fuel price hike could also trigger RBI's rate hike trajectory, especially when we've already seen not just retail inflation but wholesale inflation also at about a 3.5 year high?
I think RBI has already indicated that they're going to look beyond the war. So I
Hmm.
think the war RBI is looking at the war as a particular short-term pain point. Yes, it has been unpredictable in terms of when we would expect it to end, but end of the day, all said and done, it's still a sort of panic situation which will pass. It's not a permanent reset of India's inflation trajectory. That's number one, because oil should come down to 90, 85, 80 levels, and they will look at it from that. Second aspect of it is that there's also the El Nino effect coming in and complicating stuff in terms of the monsoon and its predictions. So that's another factor which would affect food production. So food inflation plus crude inflation are two heavy factors weighing in the RBI's mind. But RBI has also started now looking. Last time they started publishing core inflation data, which is X food, X fuel, right? So I think RBI is very clear that both food and crude oil are external things which are not incontrollables, and they are subject to multiple things. To frame an RBI policy basis these two is not very appropriate. So I think last time the government clearly made a thing, they've started disclosing core inflation. And if you go by that new philosophy of tracking core inflation, there will be a rise in core inflation too due to the pass on effects of crude and others into various other products. But RBI, I think, may change the language of the policy, but I don't think that yet, in my opinion, they will try for a rate hike because these are supply side factors where directly a rate hike will not bring down the inflation. Yes, a rate cut is ruled out because you don't want to fuel demand side inflation on top of a supply side inflation. So rate cut is definitely ruled out, but they will hesitate to a rate hike because that will kill whatever growth is happening also. So I think RBI has been fairly very clear that they have a very supportive mindset. Ever since Mr. Mehrotra has come into his role, he has front-loaded rate cuts. He has been very positive about supporting the economy from a growth perspective. So I don't think he's suddenly going to change tune and say, "Oh, inflation is too high. I want to bring it down by hiking rates," because it's not going to work. How much ever you hike rates, are you going to bring down the price of imported Brent crude? No. Are you going to be able to influence the monsoon to come more? No. So you're dealing with uncontrollables on these two factors on food and fuel. So RBI to go and say, I will rate hike unless demand is exceeding and adding cost, adding the fuel to the fire, if I may say. This is adding to the inflationary pressure. But I don't see that from happening. We are just seeing signs of rural recovery. Urban demand is steady, but we are not in a craze where people are lining up in queues to buy air conditioners or anything like that. So there's no demand side inflationary pressure yet. So I am the opinion that RBI would change its language, would try to talk down stuff, but would not be venturing into a rate hike itself in the very next policy.
Okay, got it. So, you said now that we've already seen fuel price hikes and higher gold import duties as initial policy responses to the rupee weakness, if oil continues to remain elevated, what additional measures do you think the government and the RBI may be forced to consider?
So they could make it work from home a compulsory situation for all PSUs, which are in their control, government offices and PSUs, to the extent that people can work from home. They would definitely initiate that in terms of that. Second is that they could also introduce a kind of a travel cess for people who want to travel because that's adding to the cost, especially foreign travel. So they could bring in a cess on travel because directly it impacts two things, right? It brings not only the petrol but the currency also. So the currency is also important because the currency is making the crude, as it is crude is rising, the currency weakening is further making the rupee price of crude even worse, right? So currency is also an important thing to manage. So the third thing from a currency perspective they might do is to bring down the LRS limits. Each individual today is permitted to spend $250,000 outside India, right? So, but that's not helping our economy in any way. It's just people planning for their futures in terms of investing abroad. So RBI could reverse that limit down to prevent unnecessary flow of forex out of the country. So the currency is again important. As far as other things are concerned, I don't think that an overall income tax petrol cess is an extreme step which will hurt the middle class. So it may be the last thing the government will do, but that's one of the assurances in their armor that they will look at because you have to balance the fisc. So you may have to raise revenues from some perspective. Beyond that, I don't see extreme steps like rationing of petrol or LPG or anything like that happening. Those I think will be very very last steps that the government may consider. But I think at the present moment of time, these measures should do in terms of keeping things at bay. But definitely, from a currency perspective, they could look at doing a swap to raise dollar resources to at least prevent that from hurting us. And on gold, is there a chance for a further hike in the import duties? It depends on how they see the public reaction to it. If they see public demand coming down, they will not act. But if what they have spoken about telling people don't buy jewelry and all that, because gold is an unproductive asset. See, that's the key thing, right? The government has to make sure that the engines of the economy are running. So petrol and diesel to a larger extent are critical for the economy to run. So that's the last thing they'll go and hurt in terms of curbs, in terms of supply or rationing. But gold and foreign travel and remittances outside India for investment by people, all these are not directly contributing to GDP growth, and hence putting any actions on them are not going to hurt our growth path. So I think those are the soft targets they will first go after. And gold, definitely. But I think that in the case of gold, the jewelry demand, before the Prime Minister's speech itself, I was seeing that the gold demand has already come down by about 20% year on year from a jewelry perspective. Yes, ETFs have grown up, but they are a fraction of the total gold that is bought, right? Hardly 14, I think maybe not even 10%. So the key thing here is, I think, gold jewelry already, because the prices have gone beyond middle classes budgetary expectations, right? It is too costly. So I think there you will see the decline continue with the import duties now going up. So there may not be need for any further excess on gold because the numbers could sharply drop. The previous time a gold tax was introduced way back, I think a decade ago, there was a sharp drop in gold volumes at the counters. So yes, so I think gold they've already done it. I think they may not need to do much more because volume should come down. But definitely these other three areas that I mentioned, right? I would say that those are the next steps, at least from a currency perspective, because currency is hurting us on the oil front.
Okay, got it. So, Ilse, just one last question before I let you go. At a time like this, what is the investing strategy that you would recommend investors to approach markets when it is completely highly volatile, oil prices are completely behaving in a stubborn manner, staying above that $100, and rupee every day we are hitting a new record low? So at a time like this, what do you think investors should do?
I think first of all, investors shouldn't panic. They shouldn't redeem any of their investments in this time. Number two, I believe that they should continue to accumulate, but do it staggered, do it diversified, right? And do it in small amounts every day. Because I believe that this set of crises, the geopolitics effect, right? And even if the El Nino monsoon effect, are all temporary. So if you're investing for your medium-term goals of 3, 5, 7, 10 years hence, right? These opportunities later you could look back in the rearview mirror and say, oh, why didn't I buy then? It needs a lot of courage to do what I'm saying because you're panicking today and your emotions are overcoming. Your fear is obviously dominating. I accept that. But you have to discipline yourself, overcome that fear, and keep putting small amounts into the market in a diversified manner. Now, how do you construct the portfolio there? Uh, I will tell you that you have to stay diversified. Do not do sector picking because you are seeing from the earnings season. And one day, one company in a sector does very well. Another day, in the same sector, another company gives a dramatically opposite result. And the market is tending to react to the earnings because that's the hot button trigger today. So don't be reactive to that. Keep a diversified allocation. And I would say that clearly put in your mind what a value portion of your portfolio is and what a growth is. And today you have to give value a predominance. So you will probably put 60% in value and 40% in growth. But then as the war ends and everything, you can then shift it the other way. But right now, in terms of the value, I would actually talk about from a thing that larger caps are the reasonably valued territory because recently you mentioned I saw that this week mid and small caps have had a bad week. But if you look at the last 1 year or the last 1 month, both mid and small caps have outperformed the broader market because both domestic mutual funds and HNI and retail investors have been buying from April onwards, seeing the correction. Now, that's given it a lot of support to the market, but it's still the higher risk segment here because they are much less in floating stock, and hence even small buying has tended to take their prices up. So I would say stay cautious, still put 50-50 in terms of large and mid and small, I would say, because larger represent value. And when this crisis is over, I do think that the level of FIS selling, which has been very high since the war started, will come down. They may not turn net buyers yet, but even a sharp decrease in their selling will give a lot of support to the large cap space. So I would still say be safer in a largest cap space today. Put half of your portfolio there and put half of it in mid and small cap. And like I said, I don't want to give a sector recommendation, though from the earnings, I can tell you that the PSU banks, the auto, and the capital goods are the ones which have done very good in earnings. Pharma has been neutral and decent. IT has been disappointing. Private banks have been so-so, and FMCG and others have been fairly neutral. But this is the report of the earnings which has gone by. So the market is still trying to arrive at what the 1 year forward would be in terms of the expectation, but it's a very, very risky 1 year forward at this stage because the longer the war lasts, the more at risk your expectation of 1 year EPS is. So there is a computation of 1 year EPS which shows that in a 10-year average, we are looking okay, but is how far is that EPS reliable today is the question mark. So I would say that don't jump into these sectors and valuations and comparisons yet. Wait for the war to end from a sector view, but stick to a broader diversified 50-50 large and mid and small portfolio. I would say that's the best way to go.
Okay, got it. All right. All right, Sunil sir, lovely conversation like always and appreciate your time. Thank you so much for joining us and looking forward to more such conversations.
Thank you.